Risk is subjective. Every person perceives downside risk differently. The formula that I use to assess risk is what are the chances of the bad outcome happening and what are the consequences of this outcome. I'm Zachary Ireland, realtor for Home Life Green Team Real Estate right here in Sudbury, and I'd like to help you with your real estate investing needs today. Subscribe to our channel for more videos just like this one and reach out in the links in the description. Like I was just saying, the formula that I use to assess risk is what are the chances of the bad outcome happening versus a good outcome, and what is the payoff or downside risk of both of these outcomes. In economics, we call this expected value. If you use this simple formula for assessing risk, it will start to make a lot more sense why people do what they do, and maybe avoid some of the irrational pitfalls of decision making. Someone with paralyzing arachnophobia, for example, every time they see a spider, they fear they will be bitten. If we forget that arachnophobia is irrational and pretend that everyone who fears spiders is perfectly rational and making the best possible decision every time they see a spider, the calculation would look something like this. The probability of the bad outcome multiplied by the gravity of consequence of the bad outcome happening. Now, all the possible outcomes probabilities must add up to 1 when using fractions, or 100 if you're using percentages. Now, if the chance you will be bitten by a spider is 1.01 or 1%, the probability that you will not be bitten, therefore, is 0.99 or 99%. Now, the gravity is harder to calculate for something like this, but in financial models we use dollar amounts to apply weight to these outcomes. Now let's relate this formula to a real estate investing perspective. Now, the main concern on the horizon right now are that interest rates are going up. Maybe it will be gradual, but they could rise drastically. Assuming interest rates jump a lot, it would be useful to know the probability that you will default on your loan. For simplicity, we're going to assume you have no savings, and one bad year would put you into financial ruin. Even in this extreme scenario, the chances of you having enough money left over each year to pay for routine maintenance and bills, it's very high, and the chance of you defaulting is very low. On the other hand, the positive consequence of paying your bills on time is actually relatively small. You won't become rich for paying your bills one time. Otherwise said, the gravity of this is quite small. But the combination of these small payments over a long period of time is what creates such immense wealth. Now, the probability of you having enough money to pay these bills month after month with proper advising and conservative modeling is again very high. Later I'm going to talk more about the downside risk, but for now we'll think of the worst case scenario as defaulting on the loan and not being able to pay back your mortgage. Now again, back to our formula. The chances of default are very, very low, but the consequences are pretty severe. You'll lose the property and maybe even the equity that you've built up while you owned it. Now, I do have to point out here that the risk I'm referring to is not the same risk as in financial models. Risk in formal finance refers to both upside and downside fluctuation. That's what we call variance, or the square root of this is standard deviation. When we refer to risk here, we're only really counting half of the risk, and that is the downside risk, because we do not consider an upside swing really as risk. We consider that strictly beneficial and we discount it completely. Now, academia does not differentiate between upside and downside risk because models actually prefer stability even over unexpected gains. But when real estate investors talk about risk, we're referring to downside risk, or the chance of losing capital. We're not talking about fluctuation up and down from the mean, we're strictly speaking about the chance of going to zero or producing a negative return. Therefore, the downside risk we're talking about will always be smaller than what you would find according to academic risk, because we do not include downside risk that's still above zero. Therefore, the downside risk we're talking about here will always be actually smaller than the downside risk according to the academic model, because we don't include downside risk that's still above a zero return. Economists have known for a while that money is worth different amounts to different people. The more money you have, typically the less useful one additional dollar becomes. But again, for the sake of simplicity, I'm neglecting this aspect of risk assessment. Back to our formula. That is, what is the probability of a scenario where we lose money? And in that scenario, how much would we stand to lose? I think this is a perfect thing to think about now that interest rates have been super low for almost a decade, and with inflation rising, at some point in the future, inevitably there are going to be higher interest rates. So when this happens and lending becomes more expensive, what chance do we have of a default, and how much do we stand to lose in that case? I've broken this example into two parts. Now, part one is looking at the median or mean home prices in Sudbury from the 80s until today. Now you can see on the graph, prices go up and to the right as time goes on, but there are some dips. Now, what do these dips really mean? It means demand wasn't strong enough to drive prices higher that year. This could be because of lending, rent rates, or 100 other possible reasons, but it all boils down to investor sentiment at the time, and for some reason buyers were not willing to pay more for investment properties in that year. Now, as you can see, these are not significant crashes, they're more like small corrections. The historical data we have from the last 4 decades is a lot more stable than it is volatile. Now, to go the extra mile and be extra conservative, let's say you buy your first investment property at the height of the 2007 boom. There's a perfect storm for a real estate crash. Sentiment was positive, interest rates were low, rents were increasing, but these things obviously can't last forever. And over the next 2 years, there's a consolidation and average prices do go down by a small amount. Now, does this mean everyone who bought properties in '07 lost money? Well, not really. That's what we're going to go over in part 2 of this section. Because commercial property is usually financed, that is bought on margin, we can leverage our investments 4 or sometimes 5 to 1. This means we have a pretty strong cushion for our investment to the downside should our purchase depreciate in either its income or its comparables. Again, if you saw the writing on the wall in the year and a half it took before the recession kicked in and locked in your mortgage for 5 years, you didn't really feel the correction in '08 because you were still making a cash return and your property actually would have appreciated quite handsomely after just 5 years. Part 2 of this scenario has to do with cash on hand. I've put this interest rate hike scenario into a modern day parable to hopefully make it more understandable. This is an imaginary Sudbury guy named Mike. Mike has saved up his money and he decides it's time to buy an investment property. He calls Home Life Green Team and we set up a few appointments to go and see some properties. So far, so good. He doesn't have a lot of dough, so he decides to start small. We get a 3-unit building in the Donovan. For those of you outside of our market, the Donovan is a charming downtown neighborhood. It's got parks, shopping, schools, and a higher than average police presence. Closing day finally arrives and Mike inherits his new building along with the tenants from the previous landlord. Everything seems great until crisis strikes. His variable rate mortgage goes up because interest rates are hiked a 1/4 point, and then another 6 weeks after that, another 1/4 point. Mike was convinced that what goes up must come down, so he resists locking in for 5 years. Now, because of this, debt becomes more expensive. All of Mike's investor buddies have paper hands, and they think the party's over. They decide to sell. They must now all compete with each other in order to sell, and will accept a lower price just to get it off their hands. At purchase, Mike's triplex, which was cash flowing $150 per month after paying all the bills, including property management and his bank. But now it's costing him $150 a month to keep it afloat. And assuming Mike got his triplex for $300,000 with 20% down, he's actually paying down that mortgage at a rate of roughly $600 a month. It's only costing him $150 a month, remember. He has another $450 cushion, which is paying himself, even though it seems like he's paying it in order to keep it running. With a little bit of ingenuity and a little patience, after the cold, dark winter of this worst case scenario, after 5 years enjoying 0 appreciation, 0 rent increases, Mike will have paid $9,000 out of pocket. If you do the math, that's $150 per month for 5 years. But he's actually paid down his investment property's mortgage by $39,000. And again, this is the downside risk of a doomsday scenario. His friends closed out their properties for a loss, but Mike is sitting on a sizable gain. I hope that you can see now that in a cash-flowing real estate market like Sudbury, properties simply don't crash like more speculative markets do. The principal reduction on investment properties provides a moat for our portfolio to protect us from the downside of a market slide. And after 5 years, if Mike sells for the exact same price he bought for, he'll be $39,000 richer. He won't have to pay a cent of capital gains, might I add, because principal reduction is not considered taxable gain. Cash flowing real estate hedges us extremely well against downside risk and usually provides a monthly dividend in the form of cash flow. The chance of buying at a peak and losing principal over 5 years is extremely low by historical standards, and given that, the impact of buying at such a time is not quite the Armageddon we've been led to believe. The market goes up and the market goes down. Timing the market has proven extremely difficult, but time in the market has made many men and women very happy by simply buying and holding real estate right here in Sudbury. Now, I've said many times on this channel that a higher cap rate does not always mean better. The returns are typically better with higher cap rates, but a higher cap rate implies a higher risk. And in situations like this, it helps to define what the risk actually is. Now, in the example of Mike, having a higher cap rate probably actually lowered his risk of default because there's more money left over for him to pay bills. What I'm referring to is issues meeting the liability, which is mortgage payments. The strategy to defend against this downside risk has 3 distinct components. The first thing you have to know is that this defensive strategy is not available to beginner investors, and that's diversification by having many renters. Just like in insurance, if I submit a claim to my insurance company, chances are the insurance company will not go out of business. The insurance company is receiving payments from many people, and those payments offset the downside risk of one person making a claim. Now, this diversification protects the insurer, and they always take a profit in addition to make sure they get paid enough to cover their liabilities. The same principle applies as a landlord. If you're receiving payments from many tenants, this insures you, the investor, against the unfortunate event of a bad tenant or some other problem with the building. The second strategy is to seek out guaranteed or low-risk income. ODSP recipients, for example, can opt to have their rents paid for them directly to you, so there's essentially no risk of rent being late or going totally unpaid. The third strategy is available to new and beginner investors, and that is to renovate the property and to attract better clientele. By encouraging more trustworthy, more stable tenants, by perhaps charging a below-market rent, the landlord effectively lowers risk of having a problem tenant. Now, after all, we know that certain neighborhoods have a reputation for problems, but it's not the physical building or roads causing the issues. It's obviously the tenants, the people. A good tenant might need to be compensated, and that means giving them a break on the rent. Now, don't misunderstand me. Charging less rent does not lower the risk on its own. Having better tenants lowers the risk. And the way to get there are renovations and maybe charging a lower rent, and then being extremely selective with who you actually take. Let's talk about single-family rentals for a second. Now, buying single-family real estate in order to rent it might seem like a surefire, low-risk investment, and I can understand your logic in thinking that, because capitalization rates will be significantly lower for single-family than in multifamily. Part of the reason for this, though, is that investors are now competing with primary home buyers who will be able to pay more than an investor, and the market has priced single-family rental at very low return rates. But does that mean that it's actually lower risk? The problem is, like I mentioned before, is if your single tenant moves out or refuses to pay rent, 100% of your gross income is lost, and you now have to cover 100% of the expenses as a liability. In a similar scenario, having 2 tenants rent a duplex effectively cuts the risk of this scenario in half. Now, you and I know that the behavior in the real world is not perfectly aligned to this model, but the old saying definitely does apply, and that is, don't put your eggs in one basket. Don't let your entire rental income rely on one tenant. And this goes double in high-risk, high-cap rate areas. The income you will gain is simply not worth the risk in this case. Remember earlier when I talked about insurance companies? See, those companies acknowledge that a certain percentage of their clients will crash their cars or that their homes will burn down. So they always charge a premium and earn a profit from all their other clients to offset this loss. In single-family real estate, the profit received is just too small to justify the massive risk of losing 100% of your income and being on the hook for 100% of the liability. We've talked about risk of an individual asset. Now let's shift to market risk as a whole. I've seen this personally with clients who've done really well with investing and they kind of want to diversify their portfolio more. Let's say you get started in the Sudbury real estate market. The temptation becomes to invest in another city. The logic might be something like this. Sudbury is heavily reliant on mining nickel. If you want to hedge against downside market risk, you might invest in parallel in a city like Timmins, which is more reliant on gold mining. If the market for nickel softens and workers are laid off, gold more than likely will not behave in the exact same way. Now, on its face, I don't have a problem with this. As long as you go into it with this risk-reducing attitude, and not an attitude of the grass is always greener on the other side, maybe this other market will give me slightly better returns. Now, if I can make a quick suggestion, only invest in real estate markets that are adequately diversified internally in terms of their commercial enterprise. For example, Sudbury's economy is only fractionally reliant on mining. We have strong sectors in education, regional headquarters of companies, healthcare, financial services, retail, engineering, film and television, as well as a pretty strong leisure and tourism sector. Now, when we're talking about downside market risk, a diversified economic city like Sudbury is preferable to a single employer city or one that's more reliant on any one sector. The grass is not always greener, and you could be buying property in a ghost town that becomes very hard to divest. Aside from the knowledge to avoid fragile economic areas, it doesn't really pay for small investors to hedge their downside risk by buying in multiple real estate markets. I would recommend once you find a trustworthy team with a real estate professional, a property manager, contractors, etc., just stick with it and double down on that city. Now, I'm kind of going on a tangent here, but diversification, like they do at hedge funds, is not designed to make you rich, and investing in multiple real estate markets rather than just one will not make you richer any faster. Actually, I would say taking your attention away from the best one possible city will slow you down, if anything. Now, hedge funds were conceived to protect capital from downside risk, and this should be the only attitude you take while investing in markets other than Sudbury. Essentially acknowledging that you're giving up a higher return in exchange for some downside protection. In a similar fashion, investment trusts, otherwise known as mutual funds, are typically not designed to earn the highest possible return, but rather the highest risk-weighted return, meaning the highest returns with the lowest risk. Now, once you gather a decent-sized portfolio that's well established and earning a strong return, I would say for sure go and check out other markets. I'm all about exploration, taking risk. That's one of the benefits of being wealthy, is that you can try things out and see how they go. Real estate investing in Sudbury is very safe without any need for hedging. Now, with that being said, if it's time for you to get your first investment property, give me a call and I'd be happy to give you a fair, no-pressure assessment of where I believe the market's going and if it's the right time for you and your family to jump in. Again, I'm Zachary Ireland, Realtor for Home Life Green Team Real Estate, right here in Sudbury, Ontario. Until next time.